All right, hey everybody, how you doing? Okay, so this is a video on demand. As we had an example today in a kind of an ideal setup for the what we call the gap fill or the short-term options gap fill. And what this is it first starts out with a screen that you guys don't see projected just because of real estate. But essentially, what I do is I run a scan that looks for it. It uses the same watch list as we use for all the setups in here, so that same 80 stocks. And so what it looks for is it looks for the gap percentage, and I define the gap percentage as the difference between the close yesterday and the open today. So we have and then from that, what I'm looking for is I'm looking for movers that were at least 1.5% of a gap. That's a subjective, maybe not arbitrary, but a subjective number, because you want the gap to be big enough so you actually have something to play with, and then but you don't want the gap to be so small that there's really nowhere to play, and you don't want it to be so big that you get very few hits. So that 1.5% really tends to work. So, so the specific example that we had today was in Alibaba, which is BABA. So we can see this that the close yesterday was 177.35. 177.35. The open today was basically the low, or maybe was the low. The low print this morning was 171.57. Okay, so that's your gap, which is in percentage terms is about 3.5 something, if I 3.25. All you do would take 177.35 less 177. Here, I'll bring the calculator in here. We can actually do it here. So you would take 177.35 minus 171.57. That's not correct, Mike. 177.35 minus 171.56. So that's $5.79. You would divide that by yesterday's close because you want that percentage change. And so you're looking at 3.26 or something like that, like I said. So that would definitely make it on the screen today. So then what you're looking for, and depending on how aggressive you want to be, you want to look at either the first or the first two bars. And in the case of a a gap buy, you want to let's go with the more conservative. So you would take the high of the first two bars, which would be obviously here at 177. The high of this bar is 173.37. So if we tick 173.38, which we did in the third bar, the third 5-minute bar, this is using a 5-minute chart, that is your signal to get long. Okay, so once we get that print, that's your signal to get long. Then you have to concern yourself with, okay, what am I trying to do with this? We're going to come up with target prices, and we're going to come up with stop. So your target price is going to be defined. Let me get the tracker in here, and it'll be in your day trades tracker. And down here on the left-hand side towards the bottom, you're going to see a calculator in here, the gap buy. So what you do in the case of a gap buy, because that's what we're doing, we're buying this gap. 177.35 was the high, 171.56 was the low, and we want to target 173.49, 174.46, 177.35. So 1/3 of the gap, 1/2 of the gap, full gap. Now typically what I'm doing, I'm just looking for 1/3 of the gap fill, because I'm trying. You know my trading style. Hit it, get in, get out, whatever you need to do. So now how do you define yourself where you stop yourself out? Well, again, that's a little bit subjective. If you are going to tell yourself, well, I'm going for the full gap, well, then you're probably able to give yourself a little bit of leeway as far as maybe you say, well, I need to, maybe halfway through the this bar or something like that. Or you could say, well, if we make new lows now, like I said, if we get this gap buy and we don't get and we don't get the move and it pulls right back into this range, I'm stopping myself out. So for example, if we had gotten filled on this today, we would have gotten long here. We would have ridden it a little bit higher, and most likely I would have been following my stop up here. And once we got back down into the gap, I would have stopped myself out for break even, because then it came down, then it went up again, and you can do this gap like on a second chance basis. You can say, hey, I missed it the first time, but I want to set myself an alert, and do something like this, create an alert. If we get at or above 39, I want to know about it. Of course, we are above that, so that's why that triggered. But you may have gotten in, taken a little bit of profit, or you stopped yourself out here, and then the second time we went through, well, then now it actually did fill a lot of that gap. Okay, so that is the way that the gap fill, the short-term options gap fill methodology works. It is it's I like it a lot because it tends to be successful, and then when it's not successful, it's not a big loss, because you know that as soon as you get pulled back into, or out of this gap, kind of the game is up, at least for that time. So that's that. I don't think there's any questions on that. This was recorded. I will get that out to you as soon as possible. I do want to remind you that stock and stock options trading involves significant risk. The value of your investments can fluctuate, and all of these methodologies are applied at your own risk. Again, it's Mike Shorr, Prosper Trading. The website is www.prospertrading.com. Thanks a lot for listening.